Imagine watching a single number on a screen that never stops moving. Sometimes it jumps up so fast people say, this coin is going to the moon. Sometimes it drops suddenly and fear spreads everywhere. But the real question is this: how does the price of a cryptocurrency actually move? And once you understand that, how do people talk about price predictions without guessing or misleading? This voiceover is for educational purposes only. Financial advice. Cryptocurrency is a high risk market and prices can move unpredictably. Cryptocurrency prices are not controlled by one person, one company, or one piece of news. The price is created inside exchanges where buyers and sellers interact in real time. Inside every exchange, there is something called an order book. On one side, people place buy orders saying how much they are willing to pay. On the other side, people place sell orders saying the price at which they want to sell. When a buy order matches a sell order, a trade happens. Trade becomes the current market price. This means the price is always the result of demand versus supply happening live. If more people want to buy than sell, the price moves up. If more people want to sell than buy, the price moves down. Sometimes prices move very fast because liquidity is low. Sometimes a few large orders can push the market sharply in one direction. This is why prices can rise or fall suddenly, even without major news. Now let's talk about Bitcoin. Bitcoin's long-term story is built around scarcity. There is a limited supply, and over time, the number of new coins entering the market slows down. This creates a narrative where demand can increase while supply growth decreases. However, Bitcoin's price does not move on supply alone. In the short term, Bitcoin is heavily influenced by market sentiment. If traders feel confident and willing to take risk, buying pressure increases. If fear spreads across financial markets, selling pressure can appear quickly. Large holders can also affect short-term price movement. When big buy or sell orders enter the market, volatility increases. This is why Bitcoin often shows strong long-term trends but sharp short-term swings. Now let's look at XRP. P is often discussed in the context of fast transactions and payment liquidity. Many people associate it with the idea of moving value quickly across borders. But regardless of the use case, the price still follows the same basic rule. XRP's price is determined by buyers and sellers inside the exchange order book. In the short term, its price can be highly sensitive to news, rumors, and sudden changes in trading volume. Momentum traders, term speculation, and uneven liquidity can cause rapid movements. To understand XRP, it helps to look at two things at the same time. One is the long-term narrative around usage and adoption. The other is actual market behavior, meaning what traders are doing right now. When people talk about price prediction, professionals do not give exact numbers. Instead, they describe possible scenarios based on market conditions. One possible scenario is bullish. If buying pressure increases, liquidity improves, and confidence grows, price can move upward. Another scenario is neutral. If buyers and sellers remain balanced, price may move sideways within a range. A third scenario is bearish. If fear increases, liquidity dries up, or strong selling enters the market, price can fall. This approach focuses on risk and probability, not guarantees. In cryptocurrency, nothing is certain, and managing risk is always essential. In the end, whether it is Bitcoin or XRP, price movement always comes back to the same core idea. Buyers and sellers meet in the market, and their decisions create the price you see on the screen. Price prediction is not about seeing the future, it is about understanding market behavior, recognizing different outcomes, and staying aware of risk at all times.